In this video, we are going to see 6 legal ways to avoid paying taxes on your crypto gains. But before that, let's have a look at how crypto taxes work. You pay capital gains taxes depending on the type of capital gain you have. The two types are short-term and long-term capital gains and are based on how long you hold the asset, in this case, the cryptocurrency. It's essential to realize that virtual currencies are relatively new, and the IRS or Congress may change their stances on crypto taxes in the future. But based on the current taxation of cryptocurrency, here are a few ways you might be able to help reduce or eliminate the potential taxes you may owe. But before that, welcome back to your favorite YouTube channel, NFTs Explained. Do check our description. There we have links of some amazing courses that will definitely help you in your crypto journey. So without any further delay, let's get started. 1. Buy crypto in an IRA. You may be able to invest in cryptocurrency in a tax-advantaged manner by purchasing it in a self-directed IRA. Most IRA allow you to invest in standard investments, including stocks, mutual funds, or exchange-traded. Self-directed IRA are special IRA that allow you to invest in unique assets, such as cryptocurrency, precious metals, and real estate. First, you must find a self-directed IRA that allows you to invest in the cryptocurrency of your choice. Be sure you understand how to buy cryptocurrency in the self-directed IRA you choose before moving forward. Once you have an account set up, your tax benefits will vary depending on your tax situation and the type of IRA you open and contribute to. Traditional IRA may allow you to make tax-deductible contributions, but you will have to pay ordinary income taxes on withdrawals in retirement. Roth IRA require you to contribute post-tax money to the account, but allow you to withdraw funds in retirement tax-free as long as you meet the requirements. 2. Move to Puerto Rico. If you have substantial cryptocurrency wealth, moving to Puerto Rico might help you avoid some U.S. federal income tax. Puerto Rico is a U.S. territory with unique tax benefits, including a 100% exemption on capital gains. For this reason, moving to Puerto Rico could save you a significant sum on your tax bill, whether you're looking to save on crypto or even to avoid capital gains on stocks. This strategy isn't as beneficial as it may seem, though. You have to become a bona fide resident of Puerto Rico and maintain that residency to qualify to file your taxes there. Additionally, any gains on your cryptocurrency before moving and establishing bona fide residency in Puerto Rico are still taxable in the United States at the applicable tax rates. This strategy is extremely complex, so you should consult a tax advisor before considering. 3. Declare your crypto as income. If you receive cryptocurrency in exchange for goods and services or mine cryptocurrency, taxation works differently. In these cases, your cryptocurrency is treated as income when you receive it. You must record and report the fair market value of the cryptocurrency you received and count it as income on your tax return. When you report this income, it's taxed at ordinary income tax rates. These are higher than capital gains tax rates. Your basis, a tax term used to define the currency's initial value when you received it, for the cryptocurrency you receive is the amount you report as income. When you eventually dispose of the cryptocurrency, you use that basis to calculate any capital gain you may have and pay the applicable capital gains taxes. 4. Hold on to your crypto for the long term. As long as you are holding the cryptocurrency as an investment and it isn't earning any income, you generally don't owe taxes on the cryptocurrency until you sell. You can avoid taxes altogether by not selling any in a given tax year. You may eventually want to sell your cryptocurrency, though. To lower your tax burden, make sure the cryptocurrency you sell has been held for more than a year. If it has, your cryptocurrency sale may qualify for the lower long-term capital gains tax rates. This could save you a significant amount of money on your tax bill. 5. Sell assets during a low-income year. Whether you have short-term or long-term capital gains, your income determines the tax rate you pay. The lower your taxable income is, the lower your tax rate will be. You might save money on taxes by selling cryptocurrency that you know will experience gains in years in which you know you'll pay taxes at a lower tax rate. Selling cryptocurrency might result in some income being taxed at a higher rate, but that does not push all of your income into a higher tax bracket as many people believe. 6. Hold on to it until you die. If you don't need to access the money you've invested in your cryptocurrency, you might want to use it as a generational wealth building tool. You must believe in the long-term value of a cryptocurrency for this to work, but this strategy might offer outstanding tax treatment. When you die, your assets receive what's called a step-up basis when they are passed on to your heirs. Let's say you bought $1,000 of Bitcoin today that is worth $250,000 when you die in 20 years. If you sold the Bitcoin right before you died, you'd have to pay taxes on a $249,000 gain. If you die and pass the Bitcoin on to your heirs, the basis gets increased from $1,000 to the $250,000 it is worth at the time of your death. Then, your heirs can sell it immediately without paying any income tax on the asset, since their basis is equal to their selling price. That's all we have for you today. If you enjoyed the content of this video, then give it a like and subscribe to the channel, and turn on the bell icon so that you get notifies every time we upload a new video. Until then, peace out.